Hey guys, it's Reuben here from Business Uncut. Today we have a very special guest. His name's Anthony, and he's part of the New Way Financial Planning division. Anthony, how you going today?
Good mate, how are you?
Yeah, very good, thank you. So why did I want to get Anthony on here? A lot of people have been asking me, how do we balance business and the growth in your business, and also then start to utilize cash or surplus funds in a strategic way outside of your business in terms of building wealth. Now, I want to start off this conversation by saying that our conversation, this is not financial advice. It's merely some strategies that have been used, are being used by past clients, what we see in the industry at the moment, how things are changing, some strategies that I use myself, and Anthony probably uses some same strategies as well. So
Excellent.
Anthony, a bit about yourself.
In a previous life, I was a chartered accountant, moved into financial advice. I've been doing that for about 10 years. Outside of work, I like cooking and playing some pinball.
Yeah, very nice, mate. And what Anthony didn't mention is that he's an absolute wizard in the financial planning space. And many of your clients, very high net worth clients that own businesses. And I want to obviously you deal with other high net worth that are pre-retirement on PAYG and all those sort of aspects. But I want to talk specifically about your clients that are business owners, because what we're going to do is give advice today around how they can effectively utilize their money for their business and sort of balance that, because it is a balancing thing,
It
right?
is, yes.
Cool. So many business owners think their business is their superannuation. And what we mean by that is everyone puts so much of their time, effort, resources, money into their business, which is great because your business can be one of the highest returning investments that you have. However, the multi-millionaire business owners out there, they start to diversify, de-risk, put their positions into other things rather than just business, right? And so if you're in the early stages, it's still relevant to you guys, because I believe that at some point in time, you'll start thinking about outside investments. So if we're thinking about wealth outside your business, what's the biggest danger of being all in on your business in terms of your financial resources, money?
Biggest thing that I've seen in practice, both as an accountant and as an advisor, was yes, you would put all your money into the business. Business is my super. You don't make super contributions because it's focused on the business. And then the business doesn't scale correctly, or it's in an industry that has a timeline. The business doesn't become a saleable asset, and they put all their eggs in one basket, and they don't have the retirement they thought they would.
And so you've seen this before, right? Where diversification and de-risking doesn't happen soon enough.
Yes.
Is that sort of what happens? And you can see that, yes, whilst the strike while the iron's hot in terms of business, but I also believe that there's a point there where pulling out money from your business and capitalizing on that business and putting it somewhere else is also effective. So what are the sort of risks that you see in terms of businesses falling over? And what are the key sort of points where they should start looking at diversification in their wealth?
I think probably the thing is a lot of people don't aim to seek proactive advice from their accountant about looking at their benchmarks, looking at their profitability, because once you've got a sense where you can start taking money from the business, then you've got to pursue those avenues. But if you don't know your figures, then you can't really make that decision to say, I've paid my wage, there's still another 200K profit in the business, as an example. What should I be doing with it?
And 9 times out of 10, I find you probably see this as well. The business owners out there and entrepreneurs are very optimistic.
Yeah.
Pessimism isn't in their blood. It isn't part of their DNA. And what usually happens is that they risk take it. And with risk comes maybe a bit of a blindfold against potential issues down the track. And so we haven't seen a proper recession here in Australia for how long?
Very long, not since what, 06, 07?
06, 07, something like that. And so what? We're sitting in a year lull of just improvements, increasing business wealth, properties going up. Everything is just on this trajectory that I think people have forgotten that we still live in the world of cycles.
The house can come falling down.
And it's the same as business. When there is a recession or when there is a pullback in the market, generally what happens is obviously people start to spend less, the economy slows down. Depending on what type of business you have, there's a very high likelihood that business will slow down as well. So that's one reason that we talk about building wealth outside your business. What are other reasons that you find that your clients are coming to you to try and, I guess, diversify as well?
A lot of clients don't want to be relying on the one stream of income. So I guess the buzzword that I get from a lot of new inquiries is I want passive income. So whether that's property, whether it's shares, we can't give advice on crypto, whether it's crypto, it's just having something. So if something, your employment, your job, business, whatever goes downhill, you're not purely reliant on the one stream of income.
Yeah. And then so the other things I had down here, so obviously passive income's a big one. So everyone talks about the, like you said, the keyword passive or making my money work for me.
Financial freedom's another
Financial
one.
freedom. Those are the words there. But again, you have to do something about it to get there. And a lot of people will want to do that. And so the other side of it as well is looking at personal health. You know, that I think that's a very big one that a lot of people don't talk about. Have you seen situations before where you've probably seen plenty where what would have happened if your clients didn't have the right protection and
Oh,
investments on the side?
massive. It's massive. I'm not the biggest fan of insurance companies, but we do live in a world where people go, oh, she'll be right, or it's not going to happen to me. And unfortunately, probably the least favorite part of my business is I do see that happen to people. And I love when someone is in trouble, being able to hand them a check from the insurance company and go, it's going to be okay. Focus on your health, get better. Don't have to worry about your income. But for those that don't, it's heartbreaking because they just didn't think it would ever happen to them.
100%. And you work so hard for building this business, which in most cases is probably reliant on a key person.
Absolutely.
Then something happens, whether it's, I've seen it before, where there's a heart attack or a life-changing disease or whatever it may be, but it happens. Life happens. I think we'll talk a little bit about that later as well. And I guess last but not least is succession planning. Tell us a little bit about that and just in a very quick summary, but how does that look like? What do you see from business owners in terms of succession planning?
A lot of them don't address it. And for some different types of businesses, the man or woman running the business is in fact the business. So if they're not there, the business effectively ceases to continue. So you really do need to have some sort of plan, whether it's a family member or a manager or an employee. You've got to plan early on, I think, because what's that old saying? If you fail to plan to fail, whatever it is, well, you have to put something in place.
Exactly. I take a little bit of a different approach in terms of how wealth is created outside the business. There are two forms of wealth that most business owners will look at, and that's their superannuation, their business itself. I liked, now that I do have a little one, getting further into a lifespan of our business, it's how do I create super out of super? And superannuation we probably won't be able to see, feel, or touch for a very long time.
Yeah.
The business, it does well. And so how do we then have that middle ground of having super outside of super? So that investment nest egg outside. That's then what I want to talk about next is compounding wealth with the profit from your business and excess plus of cash flow. How does that look like? So what I want to ask you is the people that focus on their business and don't use their surplus compared to someone that is proactively looking at the surplus that they have and making them both work at the same time. So what I want to hear from you is maybe you have some key stories there where we've accelerated the wealth progression. People that have started later, you can see it's much further behind those investments. What do you think about that?
The biggest thing for me with any plan is cash flow. It's being aware of your numbers. For me, one of the favorite things for me to do for someone is when they tell me they've had a kid, set up a really aggressive investment for the child, say with $1,000. You put 100, $200 a month in. I literally, no word of a lie, I had a client years ago, child turned 21, and he said, Anthony, which property do I withdraw this money for from the car? And he'd completely forgotten about it because it just built up passively because the wealth, it builds up over a long period of time if you're consistent. So the best time to start was yesterday. But with investing, you've got to be aware of your cash flow because to grow wealth, you've got to be consistent in directing the money there. You can't just turn it off and turn it on. Using the ASIC Money Smart calculator. So if you put in, I'm going to start with $1,000, let's say 7% over X amount, and you can see what it will grow to in 10, 15, 20 years time. It's a really powerful thing if you haven't looked at it.
And you probably agree with me that if you're not looking at every dollar that you have and the opportunity cost of what that dollar is doing, you're basically leaving money on the table because of inflation.
100%.
And I think that's a very powerful way to think about it. Is we hear about inflation all the time. What the inflation rate at the moment in Australia, but they were significantly higher in the last 12 to 24 months. But if you think about it, you're leaving your money in the business bank account. I'm not saying don't leave any money in there. I'm saying plus funds, which is what you probably need to try and figure out. Could you have left that in a property? Could you have left that in a managed fund? Could you have left that in even in an high interest bearing deposit? And go through what you're saying as well. But I do think that any business owner in the early stages, you probably can't do this. However, once you find stability and you analyze how much surplus you need to run the business and grow the business, then anything above that, I think, should be used for
getting that wealth from the business into your personal family wealth.
And so let's move into that. And so let's just say I was a business owner. I've been working for 5 to 10 years. I only need a couple of $100,000 in my business now just for working capital or whatever it needs. Call it $500,000 just to be safe. But I have an extra $500,000 sitting there. Maybe I've got a property or two already, I've got a PPR. And so what are the strategies or what pathway could these businesses take?
I think step one would be to talk to their accountant or advisor about how they extract that money from the business.
Yep.
Some accountants get scared of Division 7(8) or don't even address it properly, but doing that in the right way.
Yep.
And then finding out what the correct type of investment is. It will largely come down to what your taxable income is outside the business. Because if we're investing in your personal name and you're paying tax on that investment at the highest marginal tax rate, it hurts. It takes the fun out of investing when the government's taking of every dollar.
Yeah. So it's a conversation first with the accountant. What is the most tax effective way to extract this money?
Yeah.
And then having the conversation with, let's say yourself, the financial planner, to say, where do I put this money? Again, in the most tax effective way that gives us the biggest return at that time. And it could be two pathways as well, right? Obviously there's money outside of super and money inside of super, whether that be your normal industry fund or a self-managed super fund. And like we mentioned at the start, most business owners think that wealth building is their superannuation, right?
Yeah.
And so tell us some ways that once they've figured out, okay, I can safely $500,000 at the minimal tax rate. Anthony, what should we do?
If you've got properties in this scenario, you probably don't want to have too much property. For me, it's going to come down to what is your end goal for investing. So people say make money. I'm like, okay, but why? So to give you my personal situation, me and my partner Marie, we invest every month. There's going to be a sizable share portfolio there. So let's say at the age of 55, I don't want to work full time. I can scale back, have the same income. And because it's outside of super, I can access it. Where if I want to cease or slow down work at 55 and I've got a big bad super fund, I can't access it.
Yes.
So it's no good to me.
Perfect. But at least you have access to this money if you need it. And so let's talk about that, because you mentioned Div 7A. And for those listening, if you own a company, you draw money that hasn't been taxed. So generally, if you're drawing your retained earnings and your profits out of a company, you either do that through a dividend or a wage. So if you're taking it out, you're basically taking out untaxed profits. And so that's okay if it's controlled. And so a lot of business owners actually don't know that, but if you have a chat to your advisors, then we can strategize on how to use that. My biggest concern with a lot of business owners is they need access to investments, sometimes that are more liquid than others. And so what do you see there? What do you recommend in that area? So if I've got an e-commerce business and I'm like, oh, Black Friday's coming, it's in 6 months' time, Anthony, you're my advisor.
Right.
I need $250,000 to restock, and I can't get a loan because of X, Y. I've tried every other aspect in terms of cash flow. I really need something out of my investment. So where would you put money away in that instance?
Good question. My general theory is if you need access to that money within, say, before 5 to 6 years, I don't recommend the stock market. And it's purely because it's so volatile. Again, so not advice, but there are 12-month term accounts with providers like Latrobe Financial, who at the moment offer 6.25%. So it's not shooting the lights out, but it's about 2% higher than the bank.
Yes.
So you can utilize some of these funds. You've got to do your research or see an advisor who will recommend if it's appropriate. But something, if it needs to be accessed, you don't want volatility, because if you put $200,000 in a year's time, that could be $150,000, it could be $300,000. But we've got to plan for the worst case scenario.
100%. So it's good to know that there are actual products out there that may cater to the current position of your business and what you need. And I think that's very important. Yes, there are term deposits, managed funds, but it's very important to understand the rules of engagement around this.
Absolutely.
And so there's so many different products out there.
So many.
yield different returns, but also have different risk factors and opportunities for extraction of cash.
And that's a good point. You see some of these mobs on TV and they advertise like 9 to 10% returns and no risk. That just sounds too good to be true. If you could get 10% returns with no risk, everyone would be doing it. So you really got to think about where your money's going and seek advice.
Yeah. And with a really good plan, you should be able to, one, understand what your business needs in terms of cash. Two, have a strategy in place where the surplus funds being managed in a way that you have ability to split it into various types of maybe short, longer term investments, lower risk, higher risk, lower yield, higher yield. And this is where diversification starts to become very important. I'm a big fan of property at the moment. And so maybe there's a space in there, investments into commercial property or investments into residential property. And this is not a one stop plan. It needs to be very tailored to the current situation of the individual. Is that correct?
Absolutely.
Yeah, very good. And so that when we talked about that compounding effect, because this little section was all about the compounding effect. And what I've seen with the business owners that are very wealthy, from the mentors that have trained and guided me, is that you need to make your money work everywhere, in the business, outside the business. Control and discipline on both sides. Make sure you have a very systemized budget personally. You want a budget for your business and you want a budget for yourself, because you need to look at these as your business and yourself as one single unit, right? And so the advice I get is, if your money is just sitting in a bank, it's
going backwards.
It's going backwards. So where is your money best spent? So have a chat to your advisors, because 9 times out of 10, I think most people aren't utilizing their money.
And you hit the nail on the head. It's, for me, the most powerful tool in financial planning is cash flow.
Yep.
So having awareness of that, it's crucial to making decisions. And it is about trade-off and discipline. It's about going without to achieve what you're working hard towards.
Yeah. But Anthony, I'm a business owner and I love all the stuff you're saying, but I want to have holidays and I want to buy a nice car. I want to have that nice Mercedes and I want to buy a watch. How's that going to work? And so what do you usually say to people like?
That depends on what we've got to play with. If you've got a $30,000 personal surplus and you want to spend 20 grand a year on overseas, and if that's important to you, great. Like, I'm not going to tell you not to go on holidays, but it means we don't have much to play with in terms of getting ahead with your money. So it could be maybe only spend 10 grand on a holiday, invest 10 grand a year, and maybe have 10 grand set aside for emergencies.
Yeah. And what if I want more? Because the reason why I asked, what if I want more? It's because I know that you guys do it very well, where you reverse engineer the situation to what the person actually wants, needs down the track.
Yeah.
And so if I came up to you and I said, look, I really want this house on the water in Broadbeach, it's going to be $4 million, and you're only making X amount, you don't have this deposit. Things that I think you guys do really well is reverse engineer to say, you need to get to this point to be able to do it. And to get to that point, you need to have savings of this much. Your income needs to be this much. And then it goes, and then you start putting together a plan. And you guys can track like how long it's going to take for that position, right?
Yeah, we can. It's hard these days because of the cost of living. Before this, we could go back and go cut that out because it's easier to save money than earn more. Yes. A recent case I had was a client. She didn't have much surplus. She was smoking a pack of smokes a day. And I said, if you quit smoking, then I can't remember the exact number. It was about 15 or 16 grand a year. And it took her about 6 months. She quit smoking and she had then that extra money to direct towards getting ahead. So it's not a pretty conversation, and I'm not going to hold a client's hand and walk them off a cliff. But sometimes when you look at everything, if you really want it, you've got to make those hard decisions, trade off discipline. Okay, if I want to get there, so if this is my situation, what's got to give?
Yeah.
And if you don't want to give or make that sacrifice, you don't want it bad enough, I don't think.
Exactly right. And I think people don't want it bad enough because maybe they don't actually understand the sacrifice that is needed in the first instance, because no one's ever put it in front of them. And also, it's probably not clear enough what they want. I think a lot of people just go along saying, I want to be wealthy and I want to be financially free, but what does that actually mean?
And business owners are a different beast. So business owners get it because they make that ultimate sacrifice. My whole boss used to say to me, owning a business is great. You get to decide which 80 hours of the week you want to work.
Yeah.
And it's true. Business owners make the ultimate sacrifice. So for them, if you dangle the carrot of what they want and tell them what they need to do to get there, a lot of the times they'll take that on board because they're used to the trade-off, trading off family time for business time and all that sort of stuff. So
Yes.
it's a bit of an easier conversation.
Yeah, I like that. I like what you said there because it is a massive sacrifice being business owners. And what I've probably seen more prevalent over the last, let's say, 5 years is this conversation around mental health. Right?
Oh.
And so what I'm finding is that business owners don't balance their personal wealth outside of their business. So you see these guys out there, and I'm not against it, but they do say put everything back into your business, scale growth. Before I actually do that, I'm like, why are you doing it?
Yeah.
And so I'm a big fan of actually going, well, put a plan together so you can reward yourself outside for all of the hard work that you actually have done.
Yeah.
I think too many business owners wait too long to reward themselves that they start to actually regret or hate the business that they're working in, that they created.
Yeah.
You know what I mean? And so that's where I want you guys to have a bit of a different mindset if you want to, in that it's okay to reward yourself as long as it's planned.
Yeah, and that's it. Why are you doing those long hours and missing out on your social? There's got to be a reward at the end. Otherwise, you're right. You end up going, well, what am I doing?
Yeah. I've seen business 7 years, they've been hammering and they're like, we want to get this bigger and bigger. You're making $500,000 profit a year.
Yeah, how much is enough?
How much is enough? And then I asked them, I said, what are you going to do with that money? And they're like, just buy a bigger house. Would you be happy with the house that you're in, but be able to travel 6 months a year? Yeah, actually, I would love that. And so then why put more effort into building this? Unless you're building a legacy business, unless you're building something where, it's going to be a household name, legacy.
Yeah.
A lot of business owners, and I would say 90% would go into it to find financial freedom.
Yeah.
But then somehow it gets lost along the way into building this super successful
Because it
business.
becomes addictive, right? You watch it grow and grow and you just...
So if you can do it properly, going back to the compounding, I do believe that if your business is working, that's compounding there. But then if you stack on great investments outside, then those two together, so your business will probably go like this. But when you compound half the time and you're stacking up this wealth, and you'll realize that, I got to my goals, or my 10-year goals in 5 years. How did you do that? You'll see that it's worth the effort of putting the time and resources and planning now. So great business owners, what they do is they structure well, they understand the taxing points and the cash flow they have in a business, and they seek planning advice.
Absolutely.
Cool. Very good. SMSF.
Hot topic at the moment.
Hot topic at the moment. For those that do not know what an SMSF is, what does it stand for?
Self-managed superannuation fund.
So there are two ways that your super is handled at the moment, right? So the first is an industry.
You get Australian Super, Australian Retirement Trust.
Yeah. So 9 times out of 10, if you are a salary and wage earner, a lot of people in the younger years as well will have an industry super fund where it's managed externally by a third party, basically just doing the heavy lifting for you, and they're finding investments, and you'll get a little return, you get a little annual statements, and you pay them fees. You may not see the fees coming out of your bank account, but you're paying them fees. Yeah. They're there. There are a lot of fees. There's insurance in there, right? It's somewhere to protect you. Now, the other side, which what we want to talk about more, is self-managed super funds. More and more, we're seeing that as business owners grow their wealth, they turn towards a structure that will allow them to take out money from their business in a tax-effective manner. And so they put it into this environment where it has a low taxing point. Changes may occur because of the new rules. Has a low taxing point. It allows them to then choose how they spend that money. A set of rules. You can go and buy shares. What else can they buy?
Property is a big one at the moment. Crypto, Bitcoin.
Yes.
You can do some crazy stuff, which I won't mention because it's not ideal.
Some people are buying like a collectible
cars, paintings, jewelry.
Yeah.
Seen a guy's got Rolexes and he's self-managed.
He doesn't win, of course.
No,
he
of
doesn't
course
win
not.
it. Yeah, so the self-managed super fund is a great strategy for those that have excess and surplus cash in their business. It's a great strategy as well. Yes, you should be putting a little bit of money into your super every year as you go along anyway. It's a good rule of thumb, but sometimes, again, opportunity costs. It may be better to hold that in your business and grow it while it's in its early infancy years. But let's look at the self-managed super fund. And why I want to bring it up, because there is a hot topic going around at the moment, and we're talking about the new $3 million potential rule that's coming in. Can you explain to us what that is a little bit?
Yeah, so Division 296. It's meant to come into force 1st of July. It hasn't passed Parliament yet. Basically, they're saying that if you have, as a member, if your superannuation superannuation balance is over $3 million, you will be taxed on profits that you have not realized yet, and you will pay tax on that at 30%.
Yeah.
An
So
extra 15% on top of the normal super tax.
yeah, which is crazy because I personally think it's crazy because what
It
we
is
were
crazy.
trying to in this world or in Australia is to set up a system where retirees as reliant on the government.
Yep.
And so now you're switching it around and going, well, if you earn too much, and then they're going to tax you, so then people are going to be less inclined to put money into superannuation.
So they lose trust in the system, which is it's sad. But
Yeah,
that's
so
that's
losing
a hard
trust in the
one.
system. And why do we bring that up today? Because as business owners, your compounding wealth, like we talked about before, whether that's in your business and money outside of your business, that we find that business owners can accumulate that very quickly.
Mm.
You may choose to do this, so it's very important to strategize on how you put money into your super fund, SMSF, and also right now, maybe how you take it out and reinvest
Mm.
it. And so if you do have that balance or closing up to that balance of $3 million, or you're over that balance, I think you need to quickly assess and have a chat to your financial planner because this is it's tax on unrealized gains.
Taxed on money that you haven't even made,
Yes.
you haven't realized, which
Right.
is
So
astounding.
let's talk about that. So what's an example of a property? So you bought a property for $2 million 10 years ago, and now it's $5 million. What happens?
The government's proposing you pay tax on the difference in value, even though you haven't sold the property.
So on top of over and above 3 million.
Yeah,
So basically $2 million. You're going to tax it at who knows, could be an additional 15% or something like that, or what?
additional 15% is what they're
Yeah.
legislating, but it's hard to comment on it when it's still in discussion
Yeah.
phase. It hasn't been executed the best. We've just got to
Yes.
roll with the punches and see what happens.
Yeah. So what do you advise for those business owners right now that's in that situation because they haven't put it in, but they could? What do they need to do right now?
Seek advice, definitely, especially if you're close to that $3 million mark. There are strategies that we can look at which can get the money invested and you still don't pay tax on it. There are vehicles called investment bonds where if you invest in them, you hold the money in that investment for 10 years. You can then withdraw that money after 10 years tax-free. It's not perfect for everybody, but it's getting a lot of attention at the moment because a lot of people don't want to pay that extra tax.
Yeah. And there are also other tax and strategies out there where you could potentially draw down on your super to lower the balance.
Yep.
You may have a structure where, some of your family members or kids are part of your SMSF because this $3 million rule is per individual.
Per individual, yeah.
Which means that if there's a way that you can legally and effectively restructure where your wealth is held, then maybe there's a way that you can actually distribute it so no one's over the $3 million threshold.
Absolutely.
And so it's important. Look at it now because if you're waiting 6 months for this to actually be implemented, it may be too late.
And the commentary is that it could be applied retrospectively and from the 1st of July. So it's a lot of things we don't know. So you're right. Seek advice now if it's something you're concerned about.
So obviously, though, that's for those people that already within an SMSF.
Yes.
And they have that wealth in there. And so that's seeking advice. How about for people that have their business, they're starting to accumulate a fair bit of superannuation and they're wanting to decide whether an SMS is right.
Great question.
When is it viable?
Look, ASIC used to have guidelines in place. They don't have them anymore. For me, you've got to have at least $300,000 to $350,000 combined as a family unit before it becomes effective. The only reason I see it viable to set up a self-managed super fund, the main reason is being a property. So if you've got $400,000 to $500,000, you can use an SMSF to borrow. So you could potentially purchase $1 million property, but then you've got to do your research and stuff like that. For me, you've got to remember when you set it up, it's not a cheap exercise to do it, but the biggest attractor is stamp duty. So if you're buying $1 million property, there goes between 30 and 50 grand in stamp duty straight away.
Makes sense. And for a lot of business owners as well, they may want to buy their own office. They may want to buy their own commercial property. And so they may even want to buy some residential property in there. But for those business owners, and if you don't know already, you can actually purchase a commercial property, let's say an office, have that SMSF, which you own, rents it back to yourself, back to your business. And so why is this important? Because if you look at it, if you find a property where the payments are similar to the rent that you're actually paying,
Absolutely.
it means you're paying yourself that rent, and eventually that'll be your property. You're building wealth and equity with the property rather than paying it to someone else.
if I was self-employed, it is my favorite strategy. If I was self-employed, it was something I would do if the numbers stacked up, because you're getting the business is getting a tax deduction for paying down a property that you own in yourself.
Amazing, right? It's fantastic. It's absolutely fantastic. And also, like, the taxing point within SMSFs, you're looking at 15%, or you're looking at 15% to zero, depending on the circumstances that you're in.
Yes.
And so if you're different ages and you've triggered rules, then you may pay zero tax on capital gain. There's a lot of advantages in there. Now, let's pretend I'm that e-commerce business, and I said, Anthony, I've opened up my SMSF. I bought $1 million commercial property. Thank you for the advice. You said that 50,000. I found one amazing. I've moved my e-commerce business warehouse into there. Loving it. I'm paying 15 grand a month in repayments. I'm just making up those figures, by the way, but I'm paying 15 grand, and it was the same as my rent before. So I'm so happy. I've got an extra 250 grand. How should I best utilize that? Again, there's not financial advice, but how are you seeing people utilize that? In
Diversification. So if you've got a property in your self-managed super fund, you most likely own your home. Maybe you've got a rental property outside. There's no such thing as too much property, but for me, it's not putting all your eggs in one basket. So you've got the commercial property. With that extra money, you could either, if you've borrowed to purchase that property, you could look to potentially pay down that loan.
Yep.
Or you could start a portfolio of ETFs, managed funds, Bitcoin, whatever sort of gets your attention there. But again, for me, it'd be, what's your end goal? What's your starting point? Work out what average rate of return you need to do to get to where you want to be.
Yeah, I like that. Because some business owners, because of that high risk appetite, I have seen some SMSFs that are purely just Bitcoin and purely just crypto.
Yeah.
And again, not financial advice, but I probably wouldn't recommend. I wouldn't myself.
No.
Because SMSFs are built for long-term investments, and they're built to protect you financially when you retire.
Yeah.
Right? And so having too much of an aggressive play sometimes might not be the best play, because your business is already an aggressive play.
Look, I agree with it. Super is meant to be your nest egg, so you don't want to take big risks with it. Crypto is great, and there's a time and a place for it, but you don't want your super going from 200,000 to 100. It's not what super is meant for. It's meant to be a stable investment to provide your wage for when you retire.
Yes. Yeah, exactly right. And so how much can someone put in, a business owner, how much can they put into super each year?
Great question. So $30,000 a year, you can claim a tax deduction on that. If your super balance is under $500,000, any contributions of that 30,000 that you haven't used for the last 5 years, let's say there's 100,000, you can put that in as a lump sum and claim it as a tax deduction.
Yeah, great. So people that are going, damn, I missed out the last 3 years of putting super, but then now they're making some good money and they've got some cash in the background, they can say, actually, I'm happy to put an extra 50 grand or 75 grand as long as they have that cap, right?
Yeah. And I think the cap. And I think where we see it the most is client sales an investment property. They've got a big capital gain.
Yeah.
Oh, cool. I've got 100 grand I can put in to reduce that capital gain. It's awesome.
That's very good. Awesome. So that's a little bit of super. And for those that are thinking about an SMSF, again, before you do, get some guidance around the tax consequences, align it with the future plan that you have both for your business and yourself personally. This can work really well together. Very good. So that's, I guess, in a nutshell, that's SMSF. It is so complicated. So you need to get an advisor for it. There's so many different rules, regulations of what you can invest in, what you can't invest in. Some people are like, can I just take it out and start businesses with people? You can in some circumstances, but there are rules.
And big penalties if you're caught.
Massive penalty. As well. Yeah. So very good. Protecting your wealth. Let's talk about this. Something that, again, you mentioned at the start, not everyone loves to chat about it or invest into it. So I'm really talking here about life insurance and income protection. Firstly, what's the difference?
Great question. Life insurance, removing emotion from the conversation. You pass away, there's a defined set of money that you're insured for, and that lump sum payment goes to your family to cover debts is usually the main point, but normally it's debts plus extra money to, I guess, survive the situation that's happened.
Yeah, good. And then income protection?
Income protection, most of the policies, you're going to be off work for 30 days. It will cover 70% of your taxable income. The policies we set up for clients will generally pay them until the age of 65. It does depend, certain occupations, they'll limit what you can do, but basic premise is that.
Yeah, great. And so as business owners, we'll look at business owners specifically.
Yep.
When should they be looking at these? When is the appropriate time to be looking at life insurance and income protection?
Yesterday. especially if you've got a partner who's non-working and raising a family or has a different role in the business. You don't want to leave them with a mess to clean up. The biggest thing to look at for a business owner is income protection policies will have what's called an income offset clause. And in English, that means is that if your business is profitable, sometimes the insurance company won't pay you what you're insured for. So it's really appropriate to get advice.
Yeah.
On the flip side, some businesses owners don't need income protection because I've met businesses where they can say, I could be sick for a year and it's a big machine and it'll continue to
Great.
pay my wage.
Yes.
So it's really about determining if it is appropriate or not.
Yeah, great. But those businesses that have built a machine, they're usually generally larger in size. They work from something that you go for a long time.
Yes.
Everyone loves that's the ultimate dream, right? To have
Yeah.
this machine that runs by itself. I would say again, the 80-20 rule, 80% of these businesses
Yeah.
are probably run by your mum and dads.
Yeah.
You're probably run by one person who has that key man or
Yep.
risk. And I've got an example in here. We had a client that was sick and they became sick ongoing 12 months. They didn't work. And in that situation, how could income protection have helped them?
Oh, massively, especially if you've got a mortgage, at least just keeping the lights on at home,
Yes.
paying for groceries. You get to that point where if you don't have it, you're looking at selling assets. You're looking at selling the house. You're looking at potentially selling the business. And imagine being in a spot where you've busted your ass for 10, 15 years to get the business to a spot. And then because you've got no protection, you've got to sell everything you've poured everything into for the last 15 years.
Exactly right.
It'd be horrible.
You don't want to be eating into your personal wealth
Mm.
in savings and business savings. I think that's probably the wrong move. I think business owners need to do is budget the amount that needs to be paid for income
Yes.
protection and life insurance.
Absolutely.
And that way you already know it's there. And that way you don't resent it. And that way you look at your profitability and you're going, I still make 30, 35% profits on my business, irrespective of whether I pay that income protection. Just build it into your budgets.
Yep. And what I say to most clients is you can have the best business or the best wealth creation strategy in the world, but if you can't work, if you're injured, then the actual strategy is useless. So you need something to protect that strategy.
Yeah, exactly. And so it's very important. I know it's the last thing people want to hear. When you talk about insurance, you're like, oh my God, this day and age, everything changes. You can get sick, mental health, someone could accidentally hurt you, your car, whatever. There's so many different circumstances. If you have a family and you have kids, I highly recommend that you do this.
Absolutely. And you said mental health. It's so common now, which it's not good, but it's removing slowly the stigma because there's nothing stigmatic about mental health. We
Yep.
all have issues. And for me, it's if I couldn't do my job, if I couldn't talk to people with anxiety or depression, at least I'm covered. I've got it there. So you've got to plan for it.
And it's okay. And it's okay.
Yeah,
It doesn't
of
mean
course it's okay.
having income protection or life insurance, it doesn't mean you're weak.
No, God no. It's being smart.
It's
You're planning.
very, very smart. It doesn't also mean that you're betting against yourself.
Yeah.
I just think it's a very smart play, especially for the business owners that have really built wealth, continue to build that wealth.
And looking after your family as
And
well.
looking after your family, that's for sure. Let's wrap it all up. And so we were chatting about financial planning strategies for business owners. So tying or balancing wealth, personal wealth and business wealth. We talked about structuring. We talked about the importance of utilizing every dollar that you have at its maximum potential. Yes, it's in a perfect world. You would, but it just doesn't happen. What it comes down to is, are you actioning something now?
Yep.
I'm not saying every single dollar needs to be invested tomorrow. What I'm saying is, what if you could invest and have time to invest a third of the surplus that you have in something?
Have a plan at least.
Or have a plan at least. We talked about SMSFs, superannuation. And so what are the action steps for business owners today? If you could talk to every single business owner, what would you be getting them to do that would be the lowest hanging fruit right now to improve their wealth?
And the easiest, lowest hanging fruit would be have a discussion with your accountant. Talk to them about where is my business at? Do I have scope to be able to take excess money out of the business to improve our family's personal wealth?
Love that. Love that. Because I think most people just probably look at accountants and go, they're just going to handle my tax.
Yeah, which is so wrong.
Yes, they can do so much more than
Yep.
that with our clients. Some of our clients will go through and help them create a cash flow that does balance up with their wealth. And then we talk to the financial planners and how much do you guys need for them to actually
Yep.
extract from the business? What does that look like from a taxing point? Here's the structures, how we're going to get it out. And then you're like, perfect, we'll put it into this fund, we'll put it into this. some into super, invest, income protection, and then you've got this beast of a structure that
Yeah.
now is just self-generating.
Just a well-oiled machine.
It's a well-oiled machine.
And you said it then, I think that's another important part. Make sure that your accountant and your financial advisor are actually speaking. Don't
Yes.
make a decision with your advisor without running it past your accountant, because they could conflict. So the left hand's got to talk to the right hand.
Exactly. And probably the only other person that you probably need in that scenario after that is your mortgage broker.
Absolutely.
And so that'd be another great piece to that. Everyone's in that little triangle or talking to each other.
Yep.
You're in the middle and they're all working around you to make everything work in the best and most seamless way possible. Don't take your eyes off the ball in terms of your business, and I'm not recommending that you should do that.
No.
It's just, if you have the resources to be able to get someone to help you,
Yep.
then why not? Otherwise, you're just losing that money anyway.
And if you speak to your accountant and they say you're not ready yet, at least you've started. And then the accountant will say, okay, we've got to the point you want to get to. What's your plan? So
Yes.
it's at least finding out where you are, if you're ready or not. And at least if you're not, you've got something to work toward.
Love that. Anthony, we'll finish it off here, but how can we reach you?
So you can speak to the awesome team at New Wave Accounting, or you can just give us a call at New Wave Financial Planning. It's not just me. We've got a team, Wayne, Katie, and myself. We bear the cost of the initial consultation, so there's no cost to you, just to get a sense if we can value to your situation or not.
Perfect. That's newwavefinancialplanning.com.au. Call the guys located on the Gold Coast, where they're helping clients Australia-wide, not just business owners as well, high net wealth, retirees, pre-retirement. That's your jam.
That's our jam for sure.
Thanks, mate. Appreciate it.
Thanks, Reuben. Appreciate it.